Welcome to Iron Financial. We're here to help you forge a stronger portfolio, cutting right through the market's weakness to find what's truly solid. And today, we are putting Rex American Resources under the microscope. Ticker is REX. Now, on the surface, this looks like a straightforward ethanol producer, a classic, maybe even boring commodity play. But we've been digging, and what we found is a story of incredible discipline, a balance sheet built like a fortress, and a massive $1 billion bet on the future of green technology. So you gotta understand, we are not just talking about corn and fuel here. We are talking about a fundamental re-engineering of this entire business from the ground up.
Whoa, hold on a second. A transformation? Or are we talking about a massive, high-stakes gamble? Because that's the real question we need to answer today. I mean, think about it. This is a company in a notoriously brutal, cyclical industry, and they're basically betting the farm on a carbon capture project that is facing a solid wall of regulatory red tape. So the question for every single person watching is this. Is Rex a deeply undervalued, rock-solid operator that's right on the cusp of a green tech revolution? Or is this just another commodity stock, pumped full of hype, with a price tag that has already baked in a perfect best-case scenario that, might never actually happen? Let's cut through all that noise.
To really understand where this company is going, you have to first understand the foundation it's built on. And Rex's foundation is built like a fortress, seriously. Before we even get into the weeds on carbon capture, we need to talk about the core business, making ethanol. This is not some speculative startup burning through cash. Nope. This is a company that has absolutely mastered a tough business through pure, unadulterated operational discipline. The entire bull case, this whole green tech narrative we're talking about, it all rests on this bedrock of financial strength. So let's drill down and look at the hard numbers that prove it. All right, first things first, let's talk about firepower. As of their last filing, Rex is sitting on a mountain of cash equivalents, and short-term investments, and that mountain totals $375.8 million. Now, in a capital-intensive industry where commodity prices can swing wildly and just crush companies that are loaded with debt, this is so much more than a safety net. It's a war chest. This is the capital that funds their expansion, their stock buybacks, and yes, this incredibly ambitious carbon capture project, all without having to go hat in hand to Wall Street for a single dime. And this, right here, this brilliantly illustrates the discipline I'm talking about. The amount of bank debt on Rex's balance sheet? Zero. Zilch, nothing. They owe the banks absolutely nothing. I mean, this is almost unheard of in this sector. While their competitors are sweating bullets over interest payments, completely beholden to their creditors, Rex is totally unlevered. This gives them an incredible resilience. When the ethanol market turns down, and believe me, it always does, Rex can weather the storm while the other guys, the leveraged players, are forced to dilute their shareholders or sell off assets at fire sale prices. This isn't just conservative management, it's a strategic weapon. Okay, zero debt is impressive. I'll definitely give you that. But profitability is what pays the bills. A big pile of cash doesn't mean a whole lot if the business itself is bleeding money. Right. And that's the crucial point here. They aren't just surviving, they're actively thriving. This number, 20, represents their 20th consecutive profitable quarter. Let that sink in. That is 5 straight years of consistent black ink performance in the dog-eat-dog ethanol industry. That doesn't happen by accident. It's the result of relentless cost management, smart, strategic plant positioning right in the U.S. Corn Belt, and a management team that just knows how to execute. This is the kind of track record that earns them the right to make a really big bet on the future. Okay, so what's really interesting is how all these individual points come together to paint a picture of near-perfect financial health. Just look at these metrics from Guru Focus. A current ratio of 7.16, that's just a simple measure of their ability to pay their short-term bills. What it means is they have over $7 in assets ready to go for every $1 they owe in the near term. It's fantastic. Then you've got the debt-to-equity ratio of 0.04. Which is practically non-existent leverage, just like we talked about. And finally, the Altman Z-score, which is basically a corporate health check that predicts the likelihood of bankruptcy. Anything over 3 is considered safe. Rex's score is 11.55. That is in the stratosphere. This isn't just a strong balance sheet. It's a financial fortress, built to withstand anything and everything the market can throw at it. So we've established that the foundation is made of solid iron. No doubt about it. Now let's talk about the skyscraper they plan to build right on top of it. This is where the story shifts, where it goes from a steady, profitable commodity producer to a potential green tech powerhouse. We're talking about their Carbon Capture and Sequestration Project, or CCS, at their One Earth facility in Illinois. And look, this isn't just some add-on or a little side project. This is the game-changing catalyst that could fundamentally revalue the entire company. A game changer if it works. I mean, let's be real. A lot of these so-called green projects are just corporate PR, right? They're exercises in burning shareholder cash for a good headline. What on earth makes this one different? The full backing of the U.S. government codified directly into law. The Inflation Reduction Act, the IRA, completely changed the economics of carbon capture. It created this massive, multi-billion-dollar tailwind for companies exactly like Rex. Before the IRA, CCS was a high-cost, low-return science project. After the IRA, it became a highly profitable engine, underwritten by some of the most powerful tax incentives ever created. This isn't about hoping for a better future. It's about capitalizing on a clear, government-mandated financial opportunity that's sitting right there for the taking.
This slide breaks down the two key programs that matter, 45Q and 45Z. Okay, so under 45Q, Rex gets a tax credit of $85 for every single ton of carbon they sequester. Based on their own projections, that could translate to roughly $36 million a year. Pretty good. But the real monster here is 45Z. This program provides credits based on the carbon intensity score of the fuel they produce, so the cleaner the ethanol, the bigger the credit. Rex believes this could be worth up to a whopping $150 million annually. Add them together, and you are looking at a potential $186 million in annual tax credits. Now, to put that into perspective, their entire net income last year was around $58 million. These credits could literally triple their bottom line. This is a tsunami of cash flow just waiting to be unlocked.
Okay, but hold on. Those credits have expiration dates. 45Z was originally only for 2025 through 2027. That's a really short window to get a massive, complex industrial project up and running. What happens if there are delays? The whole thesis could just fall apart. An excellent point, and it's one that Congress actually addressed recently. The passage of the Big Beautiful Bill Act was a huge, huge win for RenOX. It extended that crucial 45Z tax credit all the way through 2029. That longer runway is absolutely critical. It de-risks the project significantly, giving them more time to navigate the whole permitting process and get the facility operational without that clock ticking down. It really shows that the political will behind these incentives is strong, and that provides the kind of long-term certainty that investors really need to see.
And here's the thing, this isn't some far-off futuristic dream. The plan is already generating cash. The market got a real taste of this in their latest Q4 earnings report. They absolutely demolished expectations, reporting earnings per share of $1.32 against an estimate of just 15 cents. I mean, come on. So what was the driver? They recognized $28.1 million in initial 45Z tax credits. So when the CEO Zafar Rizvi says they delivered record earnings, it's not just operational excellence, it's the tax credits kicking in right now. This is proof of concept. The money is real, it's hitting the bottom line today, and it is just the beginning. All right. You've built a very shiny, very impressive case. A fortress balance sheet, a tidal wave of government cash. Frankly, it sounds almost too good to be true. And whenever something sounds too good to be true in this market, well, it's our job to take out the hammer and start looking for cracks in the armor. Because this beautiful blueprint you've just laid out depends entirely on one thing: successful execution. And that, my friend, is very, very far from guaranteed. Let's start with the company's own words. This isn't me being cynical. This isn't some bearish analyst's hot take. This quote comes directly from the risk factors section of Rex's own SEC Form 10-K filing. We may not successfully develop our planned carbon sequestration facility. Companies are legally required to disclose what keeps them up at night, and this is front and center. They are telling investors in plain black and white legal language that this entire game-changing project could fail. That has to be the starting point for any serious risk assessment. And the reasons it might fail, they're not theoretical. They are specific political and regulatory minefields that are very real. Let's just look at the roadblocks. In Illinois, where the main project is located, the state has placed a moratorium on all new CO2 pipeline permits until at least July 1st, 2026. Their application was literally dismissed. On top of that, there's proposed legislation that could outright ban sequestration anywhere near the Mahomet Aquifer, which is exactly where their first well is planned. Then you go over to their other plant in South Dakota. The state just passed a law banning the use of eminent domain for CO2 pipelines, which makes the project for their new gen plant, and this is in their own words, more difficult to materialize. And the big one? They still don't have final approval from the federal EPA for their main injection well. The bull case just assumes they navigate all of this flawlessly. That's a heroic assumption, to say the least. But they have the cash to wait out these delays. They're not under any financial pressure. That's not the point. The point is the risk of a total write-off. They've already sunk nearly $56 million into this project. That's real money, even for a company with a strong balance sheet. If these regulatory hurdles turn into permanent walls, that $55.7 million and potentially a lot more gets written down to zero. That's a direct hit to book value and a massive blow to management's credibility. The cash on the balance sheet doesn't make the risk of failure disappear, it just quantifies what they stand to lose.
And this is exactly why the success of the CCS project is so critical. Because while you call the core business a fortress, it's really a fortress built on shifting sands. The profitability of any ethanol producer comes down to one simple, incredibly volatile metric: the crush spread. It's the margin between what they sell their ethanol for and what they pay for the corn to make it. When that spread is wide, they print money. When it narrows or even goes negative, they lose money on every single gallon they produce. And Rex has absolutely no control over it. And this volatility is just baked right into the model. Look at their own numbers from the 10K comparing fiscal 2023 to 2024. Net sales down 23%, gross profit down 7%, net income down 4%. Now look, they were still profitable, which definitely speaks to their operational skill. But a 23% revenue drop in 1 year just shows you how violent the swings in this industry can be. This isn't a stable sauce business with recurring revenue. It's a commodity business, plain and simple. They are making this massive, high-risk bet on carbon capture precisely because their core business is so volatile and unpredictable. The CCS project isn't just a growth driver, it's an escape hatch from the brutal economics of the ethanol cycle. Well, volatility is a given in the commodity space. Strong operators know how to manage it. The real debate here comes down to what you're paying for that risk and that reward. The market is always forward-looking. The question is, has it correctly priced in the potential of this transformation? Or is it still treating Rex like a boring old ethanol company? Or has it gone way too far in the other direction? Is it now priced for a perfect, flawless execution of an incredibly risky plan? That's what we need to put under the microscope right now. Okay, let's break down the bear case on valuation. According to Guru Focus, the stock is significantly overvalued. Its price-to-sales ratio is near a 10-year high. Its technical RSI, that's a momentum indicator, is at 68, which is bordering on overbought territory. And that often suggests the stock has run up too far, too fast. The market is euphoric. It has seen the shiny object, the tax credits, and has bid the stock up to a level that just assumes the carbon capture project is a done deal. It assumes regulatory approval is guaranteed and the cash will flow uninterrupted. Any hiccup, any delay, and this valuation could collapse under its own weight. The hype has been priced in. I see it completely differently. The market is just now waking up to this story. For years, this was just a story. Now, it's a reality. That massive Q4 earnings beat, $1.32 versus a 15-cent estimate, that wasn't hype. That was $28 million in real tax credit cash hitting the books. The market isn't pricing a story anymore, it's starting to price in execution. And when you look at analysts like Exit Edge, they see it as reasonably valued with 16% upside potential from their price target. They're not looking at the past, they're looking at a future where the earnings power of this company has fundamentally tripled. The re-rating has only just begun.
And this chart proves the point perfectly. This is the price-to-sales multiple over time. For years and years, the stock traded at a multiple well below 1x sales, which is pretty typical for a low-margin commodity producer. But look at the right side of the chart. We've seen a vertical surge. The market is now paying a premium for Rex's sales that it hasn't been willing to pay for nearly a decade. This visualizes the euphoria perfectly. The expectations are now sky high. Investors are paying a growth tech multiple for a company that still gets the vast majority of its revenue from a cyclical commodity business. That is a dangerous, dangerous combination. So what we have here are two clear, opposing narratives. A company with a history of ironclad discipline, making a bold, calculated bet on a transformative technology, and it's backed by massive government incentives. And on the other hand, a company in a volatile industry making a high-risk gamble on a project that is mired in regulatory uncertainty, with a stock price that already reflects a perfect outcome. Let's lay it all out, side by side, so you can forge your own verdict. Okay, the bull case is built on three massive pillars. First, the fortress balance sheet. You've got a huge cash pile and absolutely no bank debt. That gives them unparalleled financial strength and flexibility. Second, proven operational excellence. 20 straight profitable quarters prove they can execute in a tough industry. And third, a massive game-changing catalyst. Those CCS tax credits represent a potential tripling of their earnings power, a transformation that is already starting to show up in the results. But the bear case stands on three equally strong pillars. First, a volatile core business. The legacy ethanol operations are entirely dependent on that unpredictable crush spread, as we saw with that 23% revenue drop. Second, extreme regulatory risk. The entire growth story is contingent on navigating a minefield of state and federal permits that could delay or even kill the project entirely. And third, a stretched valuation. The stock is trading at historical highs, suggesting the market has already priced in the bull case, leaving very little room for error and significant downside if anything goes wrong.
So that's the battlefield. You have the undeniable financial strength and the sheer scale of the opportunity, weighed against the profound operational and political risks and a valuation that absolutely demands perfection. So this brings us to the final question that you, as an investor, have to answer. Is Rex American Resources successfully forging a next-generation green tech powerhouse on a foundation of solid iron? Or is this ambitious structure exposed to the political elements at risk of rusting away before it's ever even completed? The answer to that is going to determine whether this is one of the great value plays of the decade or just another cautionary tale of hype and hubris. That's for you to decide. Thank you for joining us at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.